Well, good evening, everybody, and welcome to the March 2025 Investing Roundtable. We're sponsored by the Mid-Michigan chapter of Better Investing and Manifest Investing, and I'm joined this evening by some of my good investment buddies. We do a lot of different talking about investments and working for the betterment of the better investing community. And tonight I have Mark Robertson. He's also a director with the Mid-Michigan chapter, and he's also president and managing director and chief bottle washer for Manifest Investing. He does it all with that website. Cy Lynch, who's the past chairman of the NAIC Board of Directors and has been a volunteer for Better Investing for, golly, almost as long as I have, and I've been doing it 30 years. So, Cy, you have to be somewhere close to that number, I think. And Kevin Galogli, who's from the Maryland side of the Washington, D.C. metro area, belongs to the McNova Model Investment Club out there in the Maryland chapter, and has appeared on the roundtable here a number of times to really good reviews from you folks in our audience. So we're not going to take any more time talking about the personalities, except that it appears Mark has us all playing ball this evening. There's 6 people to that team right there. Maybe we're warming up with all those balls in play, but maybe we're also playing a strange new game. I'm not sure. So let's go to the next slide real quick, okay?
All right.
Oh, I meant to notice that Cy is wearing Atlanta Braves Skechers sneakers, and that's just a tease for later on in the program. Okay.
And for Thursday.
And for Thursday, okay.
He's also
Next slide, please.
He's also sliding into home plate. He's got his sports mixed up here. Go ahead.
Everything we're doing tonight is for educational purposes. We're illustrating the principles of the modern investment club movement. If we talk about buys or sells or holds, those are personal opinions. We really think that you should be doing your own homework, forming your own judgments, and making your own conclusions before you either invest money or whether you take money out of your portfolio, either direction. We think that you're smart enough to make your own decisions and listen to us. And when you think we're full of hoo-ha, you can tell us that. And when we give you an idea that might have some merit to it, then we ask that you follow that through. Do some real homework before you decide that what we were saying is good enough to do for investment. That's Mark's email address down there, markr@manifestinvesting.com. If you want copies of tonight's slides, send Mark an email and he'll send you the slides. If you have questions about the program, or if you have comments or would like to see us do something specific in the roundtable, we've been doing it for more than 14 years now. And if you drop either one of us an email, we'll try to fold your ideas into what's coming up in the future for this program. Next slide, if you would, Mark. Here's our results. I'm not as pleased with them as I might have been a little bit ago. But we are still beating the market by 4 points. And Mark tried to make me feel better before the program started by saying that that puts us in very rarefied atmosphere. It puts us somewhere among the top 20 professionally managed funds in the universe that Manifest Investing follows, which includes over 600 different funds. So I guess I'm feeling good to be in the top 20 of 600 plus funds, but I would love to be beating the market by 5 points. Our rate of return since inception has been 15.8%, but the market has returned 11.8, And you can see by doing a simple subtraction that that means we beat the market since inception by 4% annualized, 4% year in, year out. Our goal is to beat the market by 5 points, and that orange line on the graph kind of shows that goal and how close or how far away we are from that goal. So we need to do a little bit more work to boost our par back up to that orange line. We would also like to have 55% of our stocks beating the market. We have discovered a strange dichotomy, if you will, a strange correspondence between that 55% number and a lot of the research out there that shows that's how often you have to be successful to have overall success with your portfolio. Right now, our performance accuracy is just a touch above 48%. So again, we have to do a little bit of work to get that pushed up towards that 55%. As I mentioned before, we are now moving into our 15th year. We just celebrated our anniversary last month, so 11 months from now, it'll be 15 years in the program, and we're really pretty happy with the results we've been able to put together. None of us are professional stock pickers. None of us are brokers or professional analysts, but we do adhere to the principles of the better investing community. We really believe in long-term investing, and we have some tools that help us decide whether a stock might be attractive or not so attractive in its journey up and down the price bars. So a +4 is good for tonight. I'd love to come back next month and see it up a little bit, and I hope that's where it's headed. Next slide. By the way, that red line at the bottom of the screen right there is what the professionals tell us the average investor does as far as beating the market. In other words, the average investor loses to the market by about 3 points. So we're quite a ways above that goal right there. But again, I'd like to see us moving towards that 5 above where the market is heading. I'm seeing that we get some questions about how do we measure the market. We're measuring it against the Wilshire 5000, which is an extremely broad-based index of about 5,000 stocks, give or take a few.
Sounds good. And I do want to underscore a couple of things. The average investor out there achieves a performance accuracy of 30 to 40%. That's because they're chasing hot stock tips from brothers-in-laws and people at the hair salon, etc. And we are 10th out of 650, so not so bad. Don't want to get too greedy.
Here's the top 20 in our very, very large portfolio. This is not the kind of portfolio we would ask you to put together as part of an investment club or as an individual. This is a tracking portfolio that is keeping track of all the different decisions we've made in the last 14 plus years. You can read the portfolio with that legend in the upper right corner there. The first line says 15 times, and then it has one stock listed, Cognizant, CTSH. What that means is that Cognizant has had $15,000 invested in the portfolio, and since the initial investment, Cognizant is now worth almost twice that $15,000, up to about a little bit more than $28,000. Our biggest holding is Microsoft, and if you kind of read through those lines until you get, I think Microsoft is 5 times, it is. And so only $5,000 invested in Microsoft is now worth almost $100,000, $99,678 in the most recent dashboard that we're taking a look at right now. These are the top 20 holdings. We probably have, I don't know, 140, 150 holdings in the portfolio, Mark. Is that close?
That's maybe a little bit high, but somewhere around 100.
Okay.
I haven't counted.
And we like to watch our averages. My par was 9.9% when this screen capture was taken. That's the average return in the Manifest Investing database. So we've been telling you for 14 plus years now that the average return from the stock market's around 10%, give or take a little bit. And there's that 10% showing up again, this time in the MyPar number. The potential return for this portfolio based on SSGs, just the way you do SSGs at home, the potential return is 13.1%. So we're a little bit better than 3 points above my par, and we're always moving to try to end up in the sweet spot, and the sweet spot is 5 to 10 points above the average. The 5 points is what Mr. Nicholson suggested that you should be able to achieve if you really worked hard at a portfolio, although he later said that it was a noble goal. It was a very I'm not going to say unattainable goal, but it was a very difficult goal, a very aggressive goal to set for his clubs. And he also made the point that trying to beat the market by more than 10 points is a fool's errand. So we put that sweet spot 5 to 10 points above the average, and that's the goal that we try to achieve. We try to keep quality in the upper quintile. That means the top 20%. And right now, the weighted average quality number is at 85. That's really, really good. We find that better investing portfolios hardly ever have a problem with aggregate quality. Our members understand high quality stocks and they gravitate towards stocks like that. Our growth is the one number that I think we need to work on a little bit more. We've read different values, and Mark and I have become quite fixated on the idea that to end up 15 or 5 points above the market, you probably have to grow your portfolio somewhere in the 13.5 to 14% range to make that happen. How do we know that? Well, we've studied many, many, many funds. We've seen how they've beaten the market, and we've seen what their aggregate sales in their funds are. And the ones that beat the market by 5 or more points tend to have growth at least above 13%, and most of them are at that 13.5 or even 14% range. So those are the goals that we set for ourselves. Right now, we have some par values that are very low for 3 of the stocks in the portfolio: Abbvie, Costco, and Fastenal. They're all down beneath 5%. And we also have a stock, Monster Beverage, whose relative strength index has moved up past 70 at this point. And I'm going to turn the next slide over to Mark and let him talk about it a little bit.
Yeah, and on that Monster Beverage, we don't get too excited until it hits 80, and then that becomes just a nudge to do a little sell transaction. So one of the things I put together for tonight, here are those top 3 stocks that have the lowest pars in the portfolio, updated to tonight's close. That's why they're slightly different. But you can see these are all in the 5 to 7 range. That's not horrifically low. It's low relative to the rest of the portfolio, but nothing to get too terribly excited about. Here is that 73, possibly overbought situation with Monster. And then just kind of across the board, a number of characteristics. We would like to get growth up a little bit, so it would make sense to shed some of these at some point, but I wouldn't get too fired up about selling any of these off right now. And one of the things I thought I would do, I think all of us have struggled with the size of the portfolio and thinking about quote unquote managing the portfolio, and maybe that causes a lot of stress that it shouldn't. And that's why I put these words together. It's a tracking portfolio. You really can't emphasize the same type of portfolio centered stuff that you would for a stock portfolio of 12 to 20 stocks. It becomes much more obvious when you're dealing with a traditional number of stocks within a portfolio. But what we are trying to do here is bring ideas and then keep track of how well the ideas do. And so we do have to address the positions on an individual basis, more emphasis on that anyhow, because we're trying to judge the results of our decisions. So maybe that helps a little bit. We do keep track the same way that an investment club does as far as the rate of return for the collective, but it's got 100 stocks in it. It's not going to be the same management task that we're used to in our normal size portfolios. Second thing there, the Nicholson rule, the rule's intentionally in quotes, it applies. If a company has double-digit sales growth, you want to be reluctant to sell. And you really want to hang on until that return forecast approaches zero or perhaps even negative for a core holding. And then again, consider core versus non-core when deciding, what return forecast you'd want to sell at. And of course, we use that RSI greater than 80. So again, I don't see anything here that's, if the Monster Beverage was up at 95 for an RSI and it clearly surged a tremendous amount in stock price, might be a different discussion, but I'm just not seeing anything here that's really a screaming sell.
I think, Mark, we could probably agree that these 4 stocks are core stocks, all 4 of them.
Yeah.
I don't think that we're looking at anything that's not fitting the up, straight, and parallel kind of model that we ask of a core stock. So maybe Abbvie's the most the widest variation from that up, straight, and parallel, but Abbvie is still reasonably consistent over many, many years.
Absolutely. So yeah, I just thought maybe these words would help a little bit, wrestle with them a little bit. They're by no means cast in concrete, but I just think if we start forcing ourselves to think of this as a 12 stock portfolio, it becomes a little bit different.
Well, I have 2 comments. First of all, on Fastenal, Value Line would probably disown us if we sold because they are absolutely in love with Fastenal. They basically say it's the greatest stock in the world, and so just keep buying it or holding it or whatever. I have owned Fastenal off and on, and it's in my growth stock outlook portfolio, so I follow it, and I'm just astounded at, like I said, how much the analyst for Value Line is in love with it.
Yeah, and the return forecast is rather subdued.
Yes, it is. But on the overall merits, I don't disagree with the words, as you call them. The only tension, I guess, I was trying to think of the best word, probably tension is the right word that I would point out, is that the 5 percentage points over par or over my par is more of a managed portfolio guide.
Mm-hmm.
So, ultimately you have to choose or may have to choose one or the other. Either we're tracking portfolio performance or you're tracking, as you say here in paragraph 1, and is roughly what you do in a tracking portfolio, is track the individual parts of the portfolio rather than the portfolio as a whole. So that like I said, there's a tension there.
Mm-hmm. And that's what. Go ahead, Ken.
Mark, I have a question that I'd like to add to the selling considerations and just maybe think about it for the next month. And the question might be, maybe we need to look at a group of the stocks that we've chosen over the 14 plus years and go through at least some of them and ask the question, would we still be making a presentation on this stock today? And if we can't, in all honesty, answer yes, I could see any one of us making a presentation on any one of these four stocks and making a case for why they're a good stock to hold. And there's not a whole lot on this list right here that maybe we would answer no to that challenge, but I guess Maximus jumps out at me and EPAM jumps out at me. That maybe we would be answering no for at least one of those two stocks. And I think if we looked at the entire list, we might find a dozen or so that we would, in all honesty, be saying, no, I don't think any of us would be making a presentation on, and then fill in the blank, whatever the stock would be.
Well, I can think of one. Agilon Health has been very sluggish, and I used to have that concern about Body Central, but for some reason it's no longer on the list.
That's the one that went to zero, folks. Okay.
Yeah. Well, Teletech is working on that.
Yeah, Teletech is chasing me for that honor distinction. I agree with you, Ken. I think the one other thing that I think we beat up on ourselves a little bit more than we need to is we have sold a lot. We've closed out a lot of positions. I mean, many hundreds, and that's kind of underscored here. I mean, we just provide this slide as a way to, because this is really what this is all about. We're talking about coming together, sharing ideas, and raising the probability of success. And this is a few weeks old, but it's still pretty valid. And you guys can read the boxes. And what it comes down to is that one selection of Microsoft 5 times offsets the losses from 275 positions. That's realized and unrealized. And every time I read this, it just gives me chills.
And I think it's important, Mark, to emphasize the difference between a selection and a stock. Because many of our stocks have a number of selections attached
Absolutely.
to them. So we don't hold 855 stocks. We hold 855 purchases, lots, if you will, of the stocks. So, and tonight we just looked at the Microsoft number and it was just under $100,000. So Microsoft has come back quite a bit since we put this slide up a week or so ago, maybe a week and a half ago. And I'm sure that the cumulative loss has changed also. I'm hoping it changed in the right direction, but I don't know that.
And it's also the stock to study for April for better investing. Microsoft
is cool. Hopefully that's not a curse. All right. Anything else on the subject? Or?
Yeah, I will say, Mark, that if Microsoft wasn't our largest holding in this portfolio, I would have been bringing it tonight to the roundtable. It's not very often that I find a stock like Microsoft that I consider to be somewhere in my buy zone. And when that's happening, I'm shouting it to my clubs and asking them to do a lot of homework and to, either verify my thinking or tell me I'm full of hot air. But with the size of this company in the portfolio, I just could not bring myself to say, let's add another piece of Microsoft to the portfolio. It's already 13%. So
it is fair enough. And a subject we should probably touch on in the future, 12% for this company is probably pretty historically good. It doesn't reach 15 very often. And we should probably talk about that at some point. All right, I think we better press on.
Just a moment. We have one question. If we can back up to where we were looking at Fastenal, William in the audience was asking about the FAS ACE rating of minus 0.06. What does that mean?
Oh, okay. Good question. Thank you. The analyst consensus publishes in the data that we get strong buys, which we are given 2 points. Regular buys 1, neutral or hold is 0, sell is -1, strong sell is -2. So what that is telling you is it's just a shade under hold. Very slightly weak hold, whereas Costco and Abbvie both have a 1. That's still a buy. According to the analysts. I don't recommend you pay a lot of attention to it, but it's there just for reference purposes.
And while we're talking about the chart, neither Mark nor I are quite sure what the relative momentum means yet. It's in the process of being studied, so take a look at it, but we're not assigning any value to that column at the moment, at least.
I will tell the audience that I picked a whole bunch of high relative momentum stocks for my groundhog portfolio, and I'm currently 200th out of 205 entrants. So
Good job. Way to go, Mark.
Hey, it's early. It's early. All right. I suggest we go ahead and roll, guys. It's almost 8:30.
Well, I'm going to present. I don't need an introduction, Mark. I'm talking already. Okay. I'm going to present United Therapeutics to the roundtable tonight. Let's start the slideshow. First slide. United Therapeutics is an old company. It's been around for 15, 20 years, and it was founded by a Nobel Prize winning scientist to save a daughter's life. She happened to have some physical problems that he felt with enough research they might be able to come up with a way to save the life. They never really did tell us how successful that venture was, but that was the reason the company was founded, and it was originally structured as a public benefit company. That's a way to say that profit was not the driving force in the founding of the company. They focus on very rare lung diseases. They focus on pediatric oncology, a fancy word for cancer, and they focus on organs and organ alternatives. And I'll get into that more as I talk about United Therapeutics. Next slide, please. United Therapeutics sees their growth coming for the next 8 or 10 years in 3 waves. The lighter blue, the kind of aqua color line, is their foundation growth, and they expect that to level off around $4 billion into the future. But in end of 25, beginning of 26, they will begin to have new products come online. They are in a host of clinical trials right now for many different things. We'll talk about a few of them, but they expect innovation to drive their profits into the future above $8 billion. And sometime in late 26, 27, maybe in early 28, they expect to really begin to drive profits by addressing the shortage of organs for transplant. And this is the most intriguing part of this company as far as I'm concerned. And notice that they expect that to drive a growth to about double the earnings potential out into the future. This is where they've been aiming now since the pandemic ended, and this chart, or a variation of it, has appeared in all of their investor presentations, and they keep revising it a little bit, slightly different numbers, but basically the same general timelines. And we're coming real close to that first jump, which they're calling innovation. Next slide. They have a really good track record, solid finances, operating cash flow of over $1 billion, spending less than 50% of the prior year's revenue on operating expenditures. That leaves a lot of cash to go into research and development. They are the most profitable biotech in their space, and their space includes many, many small niche biotech companies, but it also includes some of the major biotech companies. And I'll just give you a few names: Biogen, Moderna, companies like that. And United Therapeutics is the most profitable of the group, and they are pretty good stewards of capital, returning over $1 billion to their shareholders in 2024. That 23% revenue compounded annual growth rate since 2002, when Remodulin was approved, certainly gives them a really stellar track record in a industry where many of the companies are not profitable at all. Next slide. Ralinepag, they hope it'll be a household name out in the late 2026, 2027. But let's go back to Remodulin. Remodulin is a drug for PAH. That's pulmonary arterial hypertension. It's a fairly rare disease, and it's really underserved by the drug manufacturers because the market isn't as large as, say, for a GLP-1, that's the weight loss drugs or something like that. But Remodulin came to market in 2002, and then some variations on Remodulin, basically the way that it was administered, were brought to market in 2004. And then we got some more ways that the drugs were administered in 2009, and again in 2013, and again in 2022. And they're working right now in stage 3 clinical trials. That's the last stage before it gets approval from the Federal Drug Commission, the FDC, but the new drug will be called Ralinepag if it gets approved, and the new drug will be bringing the dosage from almost continuous dosage when the drug was first introduced to now once a day dosage, which is significantly different than anything that's on the market at the present time. Pulmonary arterial hypertension is a disease that mimics regular hypertension, but it has to do with the blood vessels in the lungs and the use of nebulizers and DPIs. That's drugs being administered in a powder form through a nasal spray. Those are used to try to control this particular disease. Next slide. Here's another one of their business fields. They have patents on the names, they have copyrights on the names, excuse me, and patents on some of these things that sound kind of like science fiction. Bio-artificial organ alternatives, and they're looking at 2 different types of kidneys, a type of liver, and 2 different types of livers, and these would be replacement organs for human beings that are based on organs coming from, in the most current application, which is kidney, they'd be coming from pigs that have been genetically modified. They also look at xenotransplantation. They look at regenerative medicine for the lungs, and 3D autologous printing for the lungs. That would be creating an artificial lung which could be transplanted into a human being. Next slide. I don't know how many of you have kept up with some of this current news, but in November of last year, that's right, just 4 months ago, the first successful NYU kidney transplant happened. The patient was discharged from the hospital on December 6, 2024, and he's currently still alive and doing well. This is a completely artificial kidney coming from a pig kidney, and it's been transplanted into a person that has complete kidney failure. This one living UKidney recipient is the same kind of thing that some of us lived through when we heard about the first successful heart transplant many, many, many years ago. United Therapeutics is hoping that this kidney transplant is just the tip of the iceberg. And as they run through the preclinical data and then they wait to see how well the patient accepts the artificial kidney and functions with the artificial kidney, eventually they'll be trying to clear this. If it's successful, they'll be trying to clear it with the FDA and bring it to market. And it stands to be an extremely lucrative field, as kidney disease is a relatively common disease suffered by many, many people. And right now, the only progression is to go onto dialysis, which is very time consuming. It's very hard on the patient, and in many cases has a definite number of years attached to how long that can happen. Next slide. Value Line feels that sales and earnings for the company should come in at around 12% for the next 3 to 5 years. Manifest Investing thinks that sales should be about 12% for the next 5 years. And Manifest suggests that earnings 5 years from now should be a little bit more than $43. You might want to kind of internalize those numbers as we look at my SSG. Next slide. I've set my growth rates at 12% for sales and earnings. That means that I'm basically accepting what Value Line and Manifest suggest might be growth rates. Notice that for the last 4 years since the pandemic, the growth rates have been significantly greater than 12%, but that 12% is represented by the dotted line on the graph that you're looking at. And then those 3 dots out into the future are Morningstar's estimates for where the sales and earnings might be into the 25, 26, and 27 fiscal years. And that 12% seems to mimic the Morningstar opinion as well. Notice that I've circled the earnings per share that a 12% growth rate would give me from the most recent end of fiscal year earnings per share. And it comes out pennies ahead of where Manifest suggests the earnings per share number should be in the next 5 years. So I think all in all, I'm approximating and being very reasonable with the data that I'm collecting from a number of different sources. Next slide. 5-year average PE of about 13.6, current PE underneath that at about 12.7, but Value Line and Manifest both suggest that there might be PE expansion coming in the next 5 years. Value Line suggests an average PE in 3 to 5 years of around 18, and Manifest suggests a 5-year average of around 16.5. With the historical 5-year average at 13.6, I'm going to predict a little bit of PE expansion when I complete my SSG. Next slide. I'm going to choose 20 as the forward-looking low average and high average, and 10 as the forward-looking low average. That gives me an average PE in 5 years of 15, and that places my judgment under Manifest and Value Line. In other words, I think I'm on the conservative side, but the conservative side still gives me a buy with an 8-to-1 upside downside ratio. I've selected $246 for the low price, and that is more than 20% below the current price. And when I did these slides Monday morning, the current price was around $312.94. And I think the company is somewhere in that exact same range today. I don't think it's moved very much at all. Next slide. Looking at return values, Value Line is suggesting, 9 to 20% price appreciation in the next 3 to 5 years. My SSG is suggesting 16 to 22.5% in the next 5 years. And Manifest is suggesting 18% par, again, in the next 5 years. I think my returns on my study are well within the bounds that are set by the sources that I've consulted, and I think they appear to be very reasonable. So I'm going to suggest, next slide, please, that UTHR, since it appears to be a buy at a price of around $313, I suggest we add it to the roundtable portfolio.
Good stuff. Thank you, Ken. And that is one of our best small companies for this year. So let's hope that we can catch the wave. Quick reminder that we do our bull sessions Tuesdays at 2. And with that, we will switch to Kevin Gologly from Maryland. Go ahead.
You just saw the headline. You just saw my title there. I see, Ken, huh? Well, since Ken decided to invite me on a Thursday after I just started a new job, and I said, sure, I'll whip something together. This is what you do when you're a fanboy of the magnificent mathematician from mid-Michigan. So what I'm going to do today is I'm going to look at home builders, and I'm going to zero in on one that I think is a buy today. But I just think looking at the whole field has been really fascinating. This would be the third presentation I've done just since the first of this year on home builders. So I've really become fascinated with it. Let's go to the next slide. And so some of this, I actually was talking with our #1 fan of home building, and he's in the audience, Matt Spielman, and he gave me a couple of these slides when we were talking about it. And this is from the National Association of Realtors, and it just sort of talks about, where the job gains have come post-COVID. And this slide is from like November, December of last year, so it's pretty fresh. And look at those two that I have circled in Texas and Florida. All that growth, very large states in terms of what's going on. And you'll see that when you look at sort of the home builders, look to see where their markets are and see how it sort of matches where the growth has been going post-COVID. Next slide. The other thing to consider about home builders is that they're cyclical. So they're going to expand and contract with the cycles in the economy. It means they're going to be interest rate sensitive and all. You may not always get those up straight and parallel lines, so keep that in mind. However, keep in mind that home building, and this comes from the National Association of Home Builders, is that their home building is about 3 to 5% of the entire GDP. And when you include real estate and the financing and the materials that go into it, somewhere between 15 to 18% of the US GDP is related to home building. This image here, this is sourced from Dun & Bradstreet, but it's put together by Fixar. But you really look at it is how there's really not a company that dominates in more than one state. I tried to look through it and see if I'm missing one. Maybe someone can catch it in the audience, but it really just shows you how sort of spread out the entire home building industry is. Next slide. So the other thing to keep in mind is that, like we said, they're sensitive to interest rates. Is this again so the National Association of Realtors is looking at this, and while they're not home builders, they obviously are concerned about it, is that they think they'll follow the Fed funds rate, and they think that there's going to be some more cuts, but they're not necessarily certain that the mortgage rate's going to fall. Again, to give you an idea, the 30-year fix is a great way to look at it. Currently, it's at 6.7. When I did my first of these home builders presentations, In January, it was 6.9, but the median yearly average is about 4.1 over the last 10 years. So they're still looking at some growth that's going on. There's still a talk of there's being a housing shortage, and so there is some opportunity here. We just have to be sort of selective in where we go. Next slide. The other thing is that I was really amazed at how lightly covered home building is inside our community. If you look at it, the latest issue of Better Investing, April is always their top 200. There's only one stock that's a home builder in the entire top 200. It's D.R. Horton at 83. And home builders are part of the consumer cyclical sector. There's 30 different consumer cyclical stocks in that top 200 and only one home builder. If we look at the ticker heat map, the image over on the right, you can see that only Green Brick Partner shows up in there. If you look at the first cuts over on the left-hand side, I've sorted that by the most recent time it's been updated. So you can see that Green Brick has had the most recent update. It was March of this month. There's 3 studies. And if you go all the way down here, you can see that we really don't have many of them covered in here. In the Manifest 40, when I was looking at it, I couldn't find any in there. And Mark, I think when you were doing your Sweet 16, there was only one, Lennar, that showed up in your top 16 stocks. So in other words, it's a very, very lightly covered community in our community, but yet at the same time, it has a huge impact on the economy. Next slide. So you can also look at, and remember when you're looking at screens, if you see them showing up in several different places, the mantra of those of us that like to follow Ken Kavula is that something I ought to take a look at. We all sort of get down on our prayer mats and we sort of point ourselves towards mid-Michigan and we start giving the mantra that goes with it. I'm sure you do it too, right, Cy?
So, 3 times a day.
Exactly. Well, I'm not as good as you. I only do it twice a day, but hey, I have something to shoot for. But if you look at with the predefined screens, the ones in the center where I have the red box, is that if you look at, I just went through and said, okay, how many of those predefined screens have home builders in it? And so I went through all of them to take a look at, and it's kind of interesting. PHM is Pulte, and you can see Pulte's shown up 4 times. Green Brick is showing up 3 times, and Toll Brothers, TOL, shows up twice. So there's some really interesting stocks in there that are showing up in our predefined screens, and yet we're not seeming to pick them. Next slide. And if we switch over to Manifest, what I did here is I just did a 2-screen criteria. I said, give me stuff that's in the residential construction, and then those of them that had a core score of 150. So I get really pretty much rid of all the dogs. And I had it sorted by growth, and you look at it up at the top, Dream Finders is right up at the top, and Green Brick is up there pretty high. But if you look at all the rest of the numbers of decent companies, they are all in that sort of like 5 to 8% range. So it's really kind of interesting that they tend to miss a lot of our screens that we would look for. If you're saying, look, we want to get growth around 12 or 13%, what's going on? So the thing is that, I did this when I showed everyone KLAC in the semiconductors, is that once I did several of these, you start to see sort of the patterns. Here, all these home builders, location matters, whether they're off-site, which is manufactured homes, or on-site, whether they're designed for first-time buyers or people that are upscaling with their second purchase, how big the square footage is, and the price point. And there's a whole range of different ways to look at this. So let's go to the next slide. And there's really 2 companies that dominate among the top 10. Now, I'm going to give you 2 different statistics. Only about 25% of all the homes closed last year were publicly traded companies. However, among the top 10, that graph in the lower left-hand side, and this comes from a Harvard University study on housing, and they have a whole joint center on it, is that the top 2, D.R. Horton and Lennar, have really started to dominate the ones 3 through 10, all the ones that we would tend to think of. So even though it's sort of diffused, do seem to see a lot of growth and concentration that's going on. But the other thing is that if you look at these operations, is that they tend to focus, again, companies will focus in a particular area and they'll scale their operations to be able to do that. And that's sort of where they end up making a lot of their hay, is that they'll try to dominate, as I showed you earlier, that really no home builder dominates in more than one state. Next slide. So, if you look at home building, it's almost sort of like the adage of the blind men that have never met an elephant, that all sort of come on up and are trying to describe what the elephant is. So if we look at this, it can be really kind of overwhelming. And if we go to the next slide, we can sort of work through some of this. Is that I did this to be able to put together and look at all the different home builders by whether they're indice or the sale size. That's about the fourth or fifth one over. And in the center, I have the manifest core score, if you can mark that mark, and also the Morningstar financial health grade just to the left of it. Those are basically two non-price dependent, meaning there's no buy, holds, or sells in that. And you can sort of use this as sort of shopping guide to be able to sit there and say, look, I'm going to go for the better ones in here and the like. The ones down at the bottom that are sort of in that magenta, they tend to have the lowest core scores, and those are the ones I sort of am out on. And so I just sort of grouped these in sort of what I thought were kind of interesting. I really was interested in doing the manufactured homes starting at 13 where Cavco Industries is, but I just couldn't really find them as really in a good price for us. So let's hit one more thing on the slide. Here is that just remember that you cannot do an investment without having to put together a spreadsheet. That's again with those of us inside the Ken Kavula devotees. Mark, do you ever put together spreadsheets for investing?
I don't get out of bed without doing a spreadsheet.
Okay. See, this is what we do. How about you, Cy? Do you put together spreadsheets?
I at least one a week, but
okay, all right. See, this is what we do when we all sort of point ourselves to mid-Michigan. Next slide. So I should have picked something like Green Brick or Toll Brothers, two that I already did, but I decided I was going to do Dream Finders. And the reason is that, as Ken talks about this, is that if you look at stocks, look at two or three in that same industry. And I tell you, with each stock that I do, I get a much better understanding of the entire industry. Now, I'm not going to read everything to you because you can take a look at this, but Ken, you'll be really happy. 6 months ago when I did a presentation, it was one that had only been, it was an IPO a year ago. Look at this one. It was done 4 years ago. So I'm really waiting it out and stuff like that. But it just joined the S&P 600 in November. But if you look at some of the metrics that we use, we try to look for quality over on the right-hand side, they're mostly kind of so-so to mediocre and stuff like that. The quality is a little bit down. The core score is not really quite there. The health grade is a C, the value line and CFRA, they're not really sort of showing up here. And again, when we get a projected average return that's 29.3, that may be too good to be true. But then you look at the proof score, and it's right there. So maybe there's something going on here. And this is the reason why I wanted to take a look at it. Let's go to the next slide. So again, if you look at this, why did I choose Dream Finders over something that's obviously very popular like Green Brick? In fact, one of my clubs, I'm actually in the MCMC, Montgomery County Model Investment Club, and not McNova. Great folks at McNova, but I'm in the MCMC, is that we did purchase Green Brick. But I think Dream Finders has really a potential George Nicholson triple play, in that the fact is that we have a depressed stock price. Look where the current price is on the visual analysis. The increasing profit margin, if you look at the 2A, the pre-tax profit on sales, it's green and going up. And the potential higher PEs that are showing up, when that price bar moves above where the earnings line is, we could be able to see some higher PE. And here's some shameless self-promotion. If you want to understand how to use a visual analysis along with the Nicholson triple play, please join us at Virtual Bink. because there'll be one of the four of us making a presentation on how to visualize value on the SSG. Next slide. So there's not a lot of coverage with this. And Ken, you were telling me when I did this, you go, make sure to have one that has like a value line. This is in the expanded edition. There's no real coverage from CFRA. So you really have to do a lot of your own work with this. So one of the things I like to do is type in not just a ticker symbol, but the name of the company and business model. And we can see here, they give a really nice description. Most of it comes straight from Dreamfinders. But the fact is that they keep talking about being an asset-light home. And in many ways, it's a lot like NVR, Ryan Homes, which is in the Reston, Virginia area, in that they don't really have they don't have a lot of land in there. What they do is they use lot brokers to be able to come on in and help buy a small segment of a larger development. And again, remember how I told you to be able to look where the growth is in the economy. It was like the second or third slide. This in the upper right, that's where Dreamfinders homes are. So if you can see that and you look back at I think it was the third slide of my presentation, you can on the second slide, you'll be able to see exactly where the growth is and where they're coming in. So they're in the major growth markets. Next slide. So the top two images, the one in the upper left and in the center right, come directly from Dreamfinders. So they keep talking about this being a land-light differentiator. And I told you a little bit about it, is that if there's a big project and sometimes the company can't finish all of the homes that are in there, someone like Dreamfinders will come on in and take a few of them. And so they do this so that they don't tie up a lot of capital. It allows them to be able to move in and out. They'll buy options on some of them to be able to get into those areas. And it works out pretty well. And they also are trumpeting the fact that they have a really higher than average return on equity. And while the numbers aren't exact there, what I do like is that the return on equity from the company somewhat trend the same way as our return on equity on the SSG, in terms of where we are. Now, the downside to this is that right above where Mark is showing you the evaluate management, I have the industry comparisons. And the industry average for home construction is 16.2, and yet for pre-tax profit, and 9.4 for the company. The return on equity is better here for the company than the industry, but the debt is higher for the company as well than the industry. I think the reflection of that is the fact that they've made acquisitions and they've used debt, they haven't diluted shares, and that's also has impacts on dropping of their pre-tax profit on sales. But the fact is it's something to watch. It's not as good as some of the others, but intriguing. Next slide. The other thing is that if you took at this, it's like, where does Dreamfinders grow? And if we start in the upper left, they're really positioned, as I showed you before, where the growth is. And if you go there, again, from their own presentation, Dreamfinders is saying that, where all the people are migrating to in the US is where their homes are. So people that are migrating are going to need places to live. So they're going to be, so they're in a well position to do it. The places where they're going in the south and the mountain, you can see where they seem to have desirable weather with strong growth, lower taxes, and a lower cost of living. Now, if you look at this, they are making acquisitions, and I thought this was really clear and straightforward from their presentation. If you look at the image over on the lower left-hand side, the blue rectangular box is their sales. And if you look at the sort of gray one behind it, that's where they had acquisitions. So you can really pretty much see where they acquired something and where their growth went from it. And if you see where that sort of red star is with the blue arrow, that's when they went public, and they went public in January of 2021. So you can see that they carried a lot of this debt when they first got on there, and they just made a big growth in terms of their acquisition here in 2025. And they had another one that rolled into, and it closed. This actually closed out in 2024 in the last one. And it really closed out in January of 2025. So you can really understand exactly where they're coming from. Next slide. So because this isn't covered in our sort of our big three of value line, CFRA, and Morningstar, you're going to have to go to SEC and see what they say to them. And looking at the management discussion of analysis, I find, again, we're taking a look at a lot of the things. If you look at the up at the top image, the second thing I have highlighted over on the right-hand side, we have lot purchase contracts for the right to purchase lots at future points in all times of these areas. And that's how they make themselves kind of nimble and be able to move around. And again, NVR Homes does the same thing. So, and in the lower part of the stuff I have, the second highlight, our strategy is intended to avoid financial commitments and risks associated with direct land ownership to increase our optionability and to increase the number of shares that they can do. So let's go to our next slide. So I usually like to find something from the CEO in which they're talking about it. And again, there's not a lot of coverage here, so you got to look around. I'd always like to see if I can find an industry trade publication, because they're going to be able to speak a bit more specifically towards that industry rather than if you were speaking to a general audience. And this was done on Builder Online in October of 2020, or about 3 or 4 months before they went public. But he started this company in his late 20s after learning to flip houses with his mother, who was a real estate agent. And again, what they do is they increase their growth, like I told you, through these lot brokers that sell them a piece of a larger development project. They still have their own, but the fact is that they've been growing their metrics in terms of the number of homes that are closed are consistently, they're under promising and over delivering on the homes that they've closed in each quarter and each year that they're doing. So they seem to be doing this in a very smart and logical way. Next slide. So rather than going through the SSG, what I've done here, and I showed you my judgments on that first one on the visual analysis, I have all my judgments here so you can take a look at it. I went with 15 and 15 for sales and earnings, because after you take that first year out of publicly traded data, that number's like right at 15. And I realize that if I sit there and be a little bit too optimistic with this, I'm going to get something that's almost nosebleed. In fact, if you look in the center there, I have a 6-to-1 upside downside ratio, but that potential price appreciation of 229 may be kind of too good to be true, because now I'm thinking that I'm going to get to something that's around, tripling my money in 5 years' time rather than doubling my money in 5 years' time. But, this is a buy up to 31.5 on my SSG. It's currently at 24.47 yesterday. And also to double check against Manifest. And Ken was talking about this with his stock. I don't have it here, but the latest, it's not on the screen capture, but if you look at the Manifest on it, their 5-year for earnings for Dreamfinders is 789. And my SSG takes it out to 672. So I'm a clear dollar below where they are. I think I'm being somewhat cautious. I realize this isn't as core and as solid as like a Toll Brothers or Green Brick, but I think because it's been beaten down so much, and as market turns around, this has a great opportunity to be able to advance. Next slide. So I have it as a young, medium-sized growth company. It's got good but not great metrics. It's clearly undervalued, but it's not too good to be true undervalued. As I told you before, I think it's a buy up to 31. And if you're, it's in that cyclical industry, but if you think that there's a future in home building, that this is a good stock to be able to consider. And let's take one more, and then we'll go over one more slide, is that we get together to be able to make sure that we always have to be able to pay homage to our devotee. And the national president of the Ken Kavula fan club took him to Portillo's, and you can never go wrong having a hot dog. That's my presentation. Thanks for listening.
Thank you, Kevin. Yeah, I think it's an interesting company, and it's my understanding that they really do target the young professionals, younger families pretty well, and that they may have taken a bit of a hit with some of the, job market news that seems to be affecting a lot of those people. That too will probably pass. So yeah, that's probably some reaction to that. Good, very interesting presentation. Thank you. All right, so we can't do one of these without talking about shoes. Bring it, Cy.
All right. We're going to talk a little bit about Skechers tonight. You could see that with the exception of the COVID year and then a bit of a hiccup on earnings in 2022, by and large, up straight and parallel, particularly in the sales revenues line, which is the most important to be steady. And the others still, again, with the exception of a few ups and downs, you see they run largely according to trend. And again, the projections are not too far off the trends as well. You could see value line projections, potential 35% gain over the next 18 months. And when the last quarterly report was put out by Value Line in January, they had a 100 to 150 3 to 5 year price target, which was a 10 to 21% annual return at 70, and the price is a little bit lower in around 60 or so now. Next slide. I just did a little bit of bouncing around, looking at existing holdings as well as some screens, and eventually decided to look at the dashboard ranked by par, and you see that Skechers is well within the good quality range, just a little under blue in quality at 78, but an excellent return at 17, and it has been purchased once in the past in the portfolio. So I said, let's look a little closer. I also like the growth rate. While it's not above the portfolio average, at 10.7, it is a pretty healthy growth rate, particularly among some of the stocks I was seeing in more general screens. Next slide. Just a quick industry study and comparison. Here you see the footwear and accessories ranked by par, and Skechers is third on that list. And then looking at the quality, it would be the fourth highest company by quality. And you see that Birkenstock is the closest balance of quality and potential return as opposed to Skechers, with Deckers and On Holding being a bit higher in quality, but lower in return. Next slide. So here's Skechers, the company, and I'm not really going to dwell too much on the product mix. We'll look more at the business model and the financials, because we all have at least some level of familiarity with what Skechers does. They call themselves the Comfort Technology Company. They're based in Southern California, and they design, develop, and market footwear, apparel, and accessories for all people, men, women, and children. They're available in about 180 companies, and they sell just about every way that you can sell. They sell through third-party retailers, so they're a wholesaler to resellers. They sell through various marketplaces, Skechers.com, and also they are building more and more Skechers retail stores, and they're a Fortune 500 company. Next slide. So here's what Skechers in their investment presentations say about the company in some numbers and pictures. They're the third largest footwear company in the world. And here again, you see the 180 countries. They actually have a little bit more than half, in fact, bumping up toward 2/3 of their sales are international sales. Next slide. And they say that they're a product-driven growth company with seeking reasonable price and high quality. You could see some of their product lines in pictures there at the on the right-hand side of the chart. And of course, the slip-ins are what they're really advertising, at least on the media platforms, primarily television, cable television that I see. That they're promoting that quite a bit. And then you can see they're diverse. They seek to lead in comfort, and they call themselves globally influenced, which makes sense if their sales are largely outside the United States. Next slide. Here's their marketing strategy. They seek digital engagement. Of course, they have traditional media, which I mentioned. They have visual merchandising in stores and elsewhere. And then they use ambassadors to influence. Again, one of their current regular media commercials are stressing one of their ambassadors. Next slide. And again, that's a spokesperson. Is what their ambassadors are. They management says they have a world-class infrastructure of manufacturing plants and sourcing, and I've highlighted a couple of things that I think is important, both just generally for a global company, but also for some of the challenges that they may be facing in upcoming. They have a diverse sourcing network, and their distribution centers are spread throughout the world, and there's 13 of them. Next slide. Now, shifting from kind of what the company describes itself as a business and its strategy for growing the company, here they show that they're a growth company, and you can see the significant revenue growth over the years and some of the significant milestones at various years. And you can see again how they are expanding the retail from 100 retail stores back in 2004. They hit 1,000 in 2015, 10 years ago, and they just opened the 5,000th. So that is a major push moving from wholesaling to other stores to selling in their own stores. The next slide. And then here they show again those channels of marketing and their markets, and you can see that they're well diversified. Notice in 2024, 26% of their sales or their revenues were international, direct to consumer. In other words, straight from Skechers, the company, through either online or on-site stores, and 36% were international wholesale business. Then you can see that domestic, 17% was direct to consumer, and just a little bit more was wholesale. So again, they're seeking to grow that direct to consumer market. And then you could see the geographic distribution there on the right-hand side of this chart. The Asian markets, so to the east, and then the European and African markets, and then the Americas. Again, Americas are a significant chunk of the business, but they are growing faster, particularly in the European market. Next slide. Here's their financial strength. Notice free cash flow, that's cash produced over their capital requirements, and they are doing extensive capital expenditures, both in their infrastructure, building more manufacturing and distribution centers, but also research and development on new products. But their free cash flow over and above those requirements, $271 million a year. So they have healthy cash. what I thought was very interesting as well, while they do have some debt to equity ratios not out of line at all for, again, a retailer manufacturer at 9.6%, but they have cash and investments of more than twice their total debt, and they're applying some of that free cash flow to share repurchases. Next slide. Their goal is to hit 10 billion in sales in 2026. You can see they've been growing over the last 4 years at about 12% compound annual, aiming toward that $10 billion sales point. Next slide. Here's the international growth, which is, again, where they're seeking to leverage their market share and expand even further as they seek to reach that $10 billion in total sales. And again, they have a good balance, both by sub-regions as well as the major regions and countries, not wedded to any particular area or country. Next slide. I've been mentioning direct to consumer and how they are pushing that. Notice the direct to consumer sales grew at 15% over the last 4 fiscal years, which is even faster than the total company growth of about 12%. And notice the target is in the low to mid-teens going forward. And they look to expand both physical stores. They're adding between 100 and 200 stores in fiscal 2025. So that gives them, puts them right in line to keep that growth up. And of course, they're continuing to increase e-commerce as well. Next slide. Here is the wholesale growth in the United States. And you notice the growth is significantly less than their direct to consumer and total growth. But again, that's what wise management does, is they seek new opportunities to build on their foundation. And again, a 9% growth rate is not bad. And that's roughly in line with what they're projecting, a little under that 8.8% in the mid single digits going forward. Next slide. Here's my judgments. Looking at it, I started with about 11 or 12% growth rate. This stock is in the Better Investing Growth Stock Outlook tracking and in a portfolio. I have featured it in the magazine. But when I was looking, I decided to reduce that a little bit based on analyst projections. Manifest analyst consensus is a little bit higher, I think at 10.7. But again, given the outsized potential return that we'll see, I decided let's be a little on the conservative or lower end of reasonable side. And so I did that. I lowered my growth, and that's a little bit in line with our sentiment for Better Investing members who have done SSGs using the online tools for Skechers. Expenses, I decided to go up a little bit from the 5-year average because profit margins are expanding and expected to continue to expand some. Left tax is about the same. And again, they're repurchasing shares, so projecting shares to fall slightly. And that led me to $7.72 potential earnings 5 years out. Next slide. All of that leads me to a potential total return of 20. And that was after, like I said, pulling back the sales a little bit toward the lower end of what I thought was reasonable and lower end of management's projections and goals and using a 19 high PE leads to a very healthy potential return of 20.3. Using the average PE of 15, again, you see a solid 14.7, which is right 0.2 below yesterday's MyPar plus 5% target. And the manifest par is 18% with slightly higher growth, as I mentioned, and similar profitability. Next slide. Value Line in its January report was very positive on Skechers, saying that investors should be buyers, and they're looking for compound annualized return in the mid-teens or so over the next 3 to 5 years. And of course, as you actually saw, potentially higher than mid-teens in the 20% or so range, which is right in line, again, with my higher end of return potential. Next slide. And then closing everything out, look at the history of Skechers price and projected returns. And you can see how the last time the red line there in the middle, which is the par value, when it was as high as it is now, was a bit over 2.5 years ago. And you could see how the price, and of course, Mark has given you a couple of the bumps where it's been about there. And you could see how the price, again, has moved a bit as the projected return moved somewhat in line with that as well, but generally an upswing, and you see a price pullback. I don't know that anybody has a perfect crystal ball for why the price pulled back when the economics are so positive for the company. My best guess, and Value Line mentioned it before the price drop and before President Trump was inaugurated, but I suspect that pullback came when the tariffs were being announced, because again, an internationally sourced company has potential tariff exposure, and I think the market recognized that, and that's why you had the price pullback. While the economic outlook still looks very solid, Value Line, like I said, mentioned potential tariff impacts on the business, but said that given the profit margin as well as the reasonable price that Skechers, the price point that Skechers tends to sell at, they felt that they were in a good position to be able to pass along potential tariff cost increases should they come along to consumers and still remain a reasonably priced product. So I'm adding another 1,000 in Skechers stock to the portfolio.
Thank you, Si. It's been in the portfolio for a while. It's a great company. I would also add that, again, this is just my opinion. I have not studied it carefully, but based on what you showed, these guys are hedged pretty well against geographic tariffs. So there may be some overreaction here. That's quite possible. I mean, they may be basically immune from some of the tariff effects that are being talked about. All right.
Very good point.
All right, so let's close down. I'll just spend a couple of minutes here. I'm going to streamline my presentation. It's premeditated, and you'll see why here in a minute. This is the Sweet 16. It is March Madness. These are the 16 stocks that have the highest, plus 4, so there's actually 20 here, that have the highest quality. So they're excellent quality for the most part, and the highest return forecast, most likely to be either in or near the buy zone of a stock selection guide. You can see that the numbers are pretty robust all the way across the page. The company that may be most oversold here, Decker's Outdoor, they've gone through some turbulence. They may be subject to some of the stuff that Si was just talking about as a purveyor of the same type of product. Mueller Industries is a company that was brought a few months ago by me, and they continue to have the strongest buy rating on Wall Street. A unanimous strong buy from Mueller Industries. And I'm just drawn to Yeti, and Manning did a very nice presentation on Yeti a couple months ago, and it's got a very respectable return forecast from Value Line. There's a real wild card here. Double Verify is in the tracking portfolio, and we've talked about it a few times, but boy, does Wall Street ever see immense potential for that company with a 37% price to fair value. In other words, they think this company could be worth $40 or $50 soon. Doesn't mean they're right. And the only red flag here comes in Kevin's industry with home builders. For some reason, the DR Horton year-over-year sales projections are flat. And that is a cause for some concern as you're just kind of sifting through these looking for a company to study closer. So in the spirit of March Madness, we went through this a little bit this afternoon. I took the top 16, seeded them, and basically went through and talked about some of these are kind of a coin flip, but others like Nice, the number 1 seed versus Mueller, that's a dogfight, almost a coin toss, a buzzer beater, something like that. So you can basically go down the list. 6 of the 8 companies on the left are already in the tracking portfolio. There's a couple on the right-hand side. I also avoided the Chinese company ZTO, and I didn't have permission to talk about home builders from Kevin yet, so those kind of suffered here in the contest. And I didn't have permission for some of the banks like Truist. I didn't have permission from Cy to present that one, or Webster. So after the first round, these were the survivors. And again, some pretty good companies that we have talked about here a fair amount. First Solar is intriguing, but I still fear government decisions getting in the way. You can see Ken's United Therapeutics here lurking. Here's Lulu over here. Pretty good shape here of late. They've had a nice recovery. Deckers is having some questionable stuff going on. So we go to the next round and just kind of pass through Nice, United Therapeutics, Schlumberger, and Lulu. And Ken admitted this afternoon that he owns all 4 of them. So we'll defer to him a little bit here, but pretty good contests all around. And I basically went with UTHR over Nice. There's some geopolitical stuff going on with Nice Systems. We've covered it a number of times, but you can see the thumbnail sketch there for United Therapeutics. Clearly an up straight and parallel situation as Ken presented it. And then you've got Schlumberger, which is basically being held out as this is not your grandfather's Schlumberger. They've gone through a bit of a transformation. They are heavily leveraged in and serve virtually all of the major energy exploration and production companies. And basically went with Schlumberger over Lulu just because, well, the economy and whatever. Just thought we'd go this way. And the 2 side by side, I probably lean a little bit more to the up straight and parallelism on the left, just looking at the thumbnails. And here's just a closer look at some of the other stuff going on with the 2 companies. That's the quality and return forecast for United Therapeutics on the left. You already heard Ken's presentation. Anytime a company is at a multi-year high with respect to the return forecast, we like it. This trend is obviously powerful. You heard about the stuff that they're doing earlier. Again, Schlumberger, not your grandfather's company. It's a little bit slower growth, but they have had somewhat of a renaissance. Some decent return forecasts here. This is a bit of a coin toss, not quite at a multi-year high. You can see that they have been improving across their metrics. I decided to go with one of the companies that is in our best small companies for this year, United Therapeutics, in the side-by-side. So, and I'm going to just basically second Ken's nomination of United Therapeutics tonight. I like a lot of the stuff that's going on there, and they're definitely doing research and development in an area of high need. I have a brother with a kidney that's failing. He's had a transplant that's going on over 20 years, almost 30 years since it was transplanted. So I have a personal connection to the issue. And I vividly remember when Walter Payton basically passed away while on the waiting list for an organ transplant. So I mean, it's an issue that is serious, and United Therapeutics is definitely doing some high caliber work in that area. So that's my selection for tonight. Seconding Ken's.
If you give me just a second, Mark, I'll get the poll going here. Okay.
And by the way, Walter Payton was given the opportunity because he was a wealthy guy to possibly move up the list. He chose not to. So I'd kind of like to see the inventory of more organs available.
We'd like all of you in the audience to vote. We're up to 60% voting. We'd like to get up into the 85, 90% range if we can. It doesn't really cost you anything. Just take your finger if you have a touch screen and hit the right one, or you use your mouse. We just hit 80%. Let's see if we can pull in another 20 or 25 votes and get up near 90% here. I'm going to count backwards from 10 in my mind, and then we're going to close the poll. Last chance, folks. And here we go. And let me share the results with you. And we had a walk away with United Therapeutics tonight. 70% of you are going to put an extra $1,000 in there.
I
don't know.
challenge the vote because I don't know what that company is. I heard United Therapeutics presented, but not you did.
That was
that's an interloper.
United Health was a misspeak, okay?
and I did hear from Canada, and Canada says that we really should have had a UTHR Ken and a UTHR Mark, and that would have, perhaps divided the ticket up a little bit. Never mind.
Well,
buddy.
Never mind. Okay, so Mark, are you going to put in 2,000 or 1,000 with the X from the audience tonight?
We're going. Well, they get to agree once, so we'll do 3,000. One for each of us.
3,000. Okay, sounds good.
And we've actually, when we
that is so hooey. You guys are just ganging up on. There it is. Poor Cy and I. We try to do our best to give you different thoughts, and look at what you guys do. You gang up on.
If there was an all of the above, and I'm not just saying this, I like all three. I really do. I happen to be sitting here in my 1994 Skechers, so I obviously like Skechers too.
I'm getting some interesting comments from Jennifer, which indicates that Kevin has really perfected his BI comedy, and Mark, you should leave the comedy to Kevin, okay?
Oh my!
Don't blame me. Blame Jennifer. Okay.
Jennifer, I'll look her up. Her account will be shut off shortly. Just kidding.
So we are. Go on, Mark. Go on.
I was just going to say a quick reminder that we do archive all of these sessions for posterity on YouTube. If you go to YouTube and search for Manifest Investing or Roundtable, you will find these sessions and some of the past, including our bull sessions and educational sessions that we do. We do have a number of things coming up. Just wanted to reinforce that we do our bull sessions Tuesdays at 2. There is a breakfast club meeting that you can access through the Heart of Illinois chapter, and it meets on Wednesday mornings at 9 a.m. and it's very nice and very folksy and an opportunity to exchange some ideas. Ken, you want to handle that first one and second one?
We've been doing help sessions. We had our first one last Saturday, and we'll be doing 2 more help sessions for novice investors. They go right along with our Getting Started series that we did on March 1st, We'll do one at 11 a.m. Eastern on April 5th, another on April 26th. We're going to be live in southeastern Michigan. If you're anywhere near Rochester Hills Library on the 19th of April at 9:30 in the morning, you're invited to come. I think the program is absolutely free, and we'll be spending the morning talking about stocks and anything else that might be of interest.
I actually
Our
think
April
that
round.
will, I was just going to say, I think that will actually erupt into like a club jamboree where we take a look at some portfolios, talk about some specifics. It could be a whole lot of fun. Come on out.
So
and
if
see us.
you're in a club, bring your portfolio along with you then, okay?
Mhm.
April and May roundtable dates are up there. Those are the last Tuesday of each of the months. The virtual convention is coming up in June. And Mark's going to be at the Georgia Investor Fair in August. Cy, will you be there as well?
I certainly will.
So Cy and Mark, you can meet them in person on August 2025 in the Georgia Investor Fair. And I'm sure there's information going to be posted soon on the Georgia chapter website. So with all that said, I'd like to thank you all for sticking around. We had a really nice audience this evening. George is asking if the April roundtable's on a Saturday. George, it should not be on a Saturday. And if that's the wrong date, I will fix that immediately. The roundtable date is the 29th. Is that what Mark has? No, Mark, it's the 29th of April for the April roundtable, okay?
You know, I always count on you guys to check me on that. And
So thanks for catching that, George. We appreciate that. And
April 29th.
of course, April 29th, right? And we will be putting out an email to our guest list, and we'll make sure that it has all the right information on it. So thank you again, Kevin, for coming to our assistance at the last moment. That was a very interesting presentation on the housing industry. Cy, as usual, a great presentation on Skechers. And Mark, you got to come up with your own stock next time, okay?
Yeah,
He was too busy. He was too busy taking you out, thinking of what Portillo's he was going to take you to.
Could very well be. Could very well be.
in our future.
And all kidding aside, Mark, you know how much we appreciate you in the Mid-Michigan chapter and all you do for us and the investors in this area, and for all the folks that come to these programs. So thanks a lot to all three of you, and I look forward to seeing you all at the next bull session, 2:00 in the afternoon this coming Tuesday. Good night, everybody.
Good night.
Good night.
Thanks, everybody. Take care.